going to the sunflower metaphor, I had this image of my head of, imagine that we're looking in our garden and we have these nice fully grown sunflowers, which if you don't know, they sprout, they can be 8, 10 feet tall. And then next to the sunflowers, we have some corn. And so we have these fully grown sunflowers kind of towering above us. And next to it, the corn blooms a little bit later, we'll say, so the corn is maybe only half grown, and there aren't any ears of corn yet on the corn stalks themselves. And now if I were to, quote unquote, invest in these crops in some way, if I were to say, well, which one's gonna do better? Which one has more growth potential in front of it? This math suggests the slice that is NVIDIA will be bigger than the pie itself. And we've all eaten enough pie to know that that doesn't make sense.
Yeah, and I can say that I definitely don't like any one stock, including NVIDIA, taking up too much of my portfolio. Typically 10, maybe 20% if it's Berkshire Hathaway, right? But for the most part, if I'm to your point about seeing this peak or stocks that just continue to go up and has all this compounding, we know that it's gonna level out at some point because it can't be bigger than what it's a part of.
Once you get to the point where you're pretty comfortable with your finances, you really need to pivot and start thinking about all the other stuff, because that's really what's going to be most important throughout your retirement, and it's what's most important in life, right? I don't think any of us want to be people who say money is the most important thing to me above relationships and my health and all that stuff.
Welcome to Catching Up to FI, a podcast on mindset, money, and life for late starters of any age on their journey to financial independence. I'm Bill, and I'm a late starter.
I'm Jackie, and I'm also a late starter, and we're your host. We're here to help you on your journey to financial independence, no matter where you're starting.
We're going to talk to experts, other late starters, and explore topics related to our mission.
Join us as we catch up to FI together.
Hello and welcome back to Catching Up to FI. Jackie, I was just out of town this weekend and we had so many things happening going on. My son graduated and my wife rang the bell saying freedom from cancer. So this has been a great weekend. We've been busy, but I'm excited to talk to Jesse Cramer today.
Yeah, I am too. And Bill, I am so happy for you and your family, son that just graduated, and our patient. She is doing great. She rang the bell. And thank you so much for sharing that with the community. If you are in the Facebook group, then you probably saw that Bill openly shared that his wife had gotten through cancer successfully. And we cannot thank him enough. So find that post and give him an applause and congratulations to him and his wife for getting through a tough time. So yes, the show goes on. And I can tell you, your wife was so supportive, even while she wasn't feeling well, of the show and what we're doing here with Catching Up to FI. And we are, of course, excited for our next guest. We weren't super familiar with his work, but boy, we went down the rabbit hole and he's pretty amazing. So let me introduce him. Our guest today is Jesse Cramer. He has a knack for using everyday experiences to make personal finance accessible for the average investor. He is the founder, writer, and voice of the award-winning The Best Interest blog and podcast. He left a career as a mechanical and aerospace engineer. Woohoo, that's big stuff right there. To work with clients as a fiduciary fee-only financial planning firm. He uses those valuable engineering skills to simplify the most complex financial topics into fun explanations for his clients and his audience. He lives in Rochester, New York with his wife, their newborn baby. I think he's less than a year old, right, Jesse? And an adorable Australian cattle dog. Jesse, welcome to Catching Up to FI.
Oh, Jackie and Bill, thank you so much for the invite. Thank you for that very generous introduction, Bill. Such great news about your family. And yeah, to answer your most recent question, Jackie, our baby girl just turned 11 weeks old. So it's a very fun time in the Kramer household.
Ooh, that's a baby.
I mean, we all have these great personal stories. And the thing about them is life throws you curveballs and the human race is incredibly resilient. Late starters are incredibly resilient. I mean, we take these things head on, and late starters have life experience as one of their superpowers going into Catching Up to FI. But without further ado, we're going to talk to a rocket scientist today. You got to tell us a little bit about your backstory so we understand who you are, whether it be the money story or the professional journey and the transition from rocket science and space telescopes to financial planning. We want to hear it.
Well, thank you guys. And yeah, it is kind of funny because rocket science is the easy introduction. I think a real rocket scientist would say, no, rocket scientists work on the propulsion systems of how things get out into space. Whereas what I was doing was working on the actual payloads, the special equipment that a rocket would launch. In this case, just like you said, Bill, satellite telescope systems. So my background's in mechanical engineering, and I spent 7 years after grad school working as a mechanical engineer. So that's most of my 20s, right? But about midway through that period, I realized I didn't really know what I should be doing with my money. I kind of hit this problem that I suppose many young or older adults face, which is I have some assets, I have some income. I know there are certain smart things I should be doing. There are probably some smart things I should be doing that I'm not even aware of. And regardless of how long those two lists are, I have no idea how to prioritize those lists. So that was kind of my impetus of learning more about personal finance, learning more about investing. How do I prioritize the smartest things I should be doing with my money? And over time, I did a lot of the same things that our listeners right now are probably doing. I listened to podcasts, I read blogs, I read books. I just devoured as much information as I could. Started sharing with some of my colleagues and some of my coworkers at the engineering firm, just little tips and tricks. Hey, here's what I'm doing in my 401k, and here's the reason why. And some of them encouraged me and said, Jesse, your explanations make sense to me. You're a pretty good teacher. Why don't you start writing some of this down? And that was the birth of the Best Interest blog. Fast forward a couple years. I've always enjoyed, my parents were teachers, so I've always enjoyed teaching, sitting in front of a room and teaching. And to some extent, I sit in front of the microphone and teach now through the Best Interest podcast, which started a couple years later. And then fast forward to, 2021, about 3 years ago from when we're recording right now. The engineering job was good, but not great. And while I was still young and at the time unmarried and at the time without a child in my life, I said, why don't I take a chance and see if I can pursue this passion of teaching people better financial planning, smarter things that they should be doing with their money. And so I took a big leap and changed careers. And right, as Jackie mentioned in the intro, I now work for a fiduciary fee-only firm here in Rochester, New York, and absolutely love it. No looking back.
Oh, you call it the Best Interest blog and podcast, and that has its origins with Benjamin Franklin, right?
It does. It does. It's a bit of a pun, play on words. Writing is fun to me. My mom was an English teacher, so I enjoy just fun writing. So yes, Benjamin Franklin said, an investment in knowledge pays the best interest. Boom. It's so true, right? So here I am writing about investment content anyway, and I believe that sharing intelligent content pays dividends in our lives. And then, of course, if we are investors, we hope to achieve best interests or good interests, good dividends, however you want to say it in your own investing career. So there's a bit of a multi-layered pun or double meaning there.
Now, it's interesting because your audience overlaps with our audience. Who are you speaking to, and why should our audience go dive into your blog and podcast?
Yeah, I think my typical reader or listener is someone who's probably between maybe say like 30 and 60, which I understand is a pretty wide age range, but it can vary from my peers. I'm 34. My peers who are kind of at that first pivot point where they say, I understand a bit of the basics, but now I need to understand things on a slightly deeper level, all the way up to pre-retirees who are very serious about, hey, retirement is right there on the horizon, and I need to get my financial planning stuff figured out. My readers and listeners, they tend to lean towards DIY. They might be familiar with the FI movement pretty deeply, or they might not be. They might just be like a 50-year-old DIYer who isn't necessarily interested in the RE part of FIRE, but they're definitely interested in the FI part of FIRE. And they might be working with a CFP or not. But either way, it's someone who leans more towards the DIYer track.
Well, Jesse, I love that you enjoy writing and you have fun doing it. To me, that comes through in reading a lot of your blog posts and listening to your podcast. So I think that's sort of something that our listeners can take away, that move towards something that's fun. You had this great career in engineering and you shifted to do something that was simply more fun, that you still get paid for doing. So for our first topic, I like this article. It's kind of timely. It's kind of a fun topic, right, Bill?
Oh, yeah. Well, we're going to cross the red line a little bit here, but try and be down the middle, so to speak, because we're going to talk a little bit about politics and the market.
And data. Let's not forget, these are data points that we're looking at, okay? It doesn't reflect any personal views or anything like that. But I find it interesting when there's actually research out there that kind of shows some things that become very emotional for us. So the title of that article that we're talking about is there a correlation between who's president and your portfolio? Or that's the subject. So talk to us a little bit about that, Jesse. Does the who's president have anything to do with our money, our portfolio specifically, and investors?
Yeah, it is. It's such an emotional topic, probably more than ever, or at least more than ever in my lifetime. You guys remember maybe further in the past, and just looking at political history, I mean, there have certainly been divisive times in at least U.S. history. But I was sitting there in July, and it was the weekend of the assassination attempt, which is what a whirlwind, what a crazy thing to have occurred. And then that week right after the weekend, where it's like, what's the market going to do this week? And just imagine if someone had asked the average American or the average listener right now, and they had said, okay, the former president and the current presidential candidate was just shot in the ear in an attempt on his life. What do you think the stock market is going to do on Monday? I have a feeling people have said the stock market is going to go crazy. I don't know what direction, but it's chaos. It's terrible. The market's going to go crazy. In actuality, I think the market changed. I'm just looking here, went up by 0.28% that Monday. A very normal, matter-of-fact, unnoteworthy day in the market. And the lesson and the takeaway is that in that particular situation of the assassination attempt, just like in many other political situations, the market does not really care about politics per se. The market might have it might care over long periods of time about economic policy, about corporate tax policy, about trade policies. Like those things can affect the market over long enough periods of time. But in general, the market doesn't care about short volatility in politics. And when we look at, there's a couple charts in this article, and you guys said you're kind enough to link the article in the show notes. When you actually look at how the market has performed over the past 50, 100 years, and you compare that against not only who's in the presidential office, but also which party is controlling Congress and those kind of things, it's very hard to find any sort of pattern in that data that would suggest that a certain party is more beneficial than the other. So long story short, the idea is that it's okay to care about politics deeply on a personal level and to care about America and to care how that's totally fine. But I would just encourage anyone listening to do your best to separate your politics from your portfolio and just let your portfolio ride. Don't mix and match the emotions between those two P words.
Now, does it matter if you have one party as president and one party dominating Congress or divided? How does that work? Because we think the president matters, we think Congress might matter, but does it matter if there's discordant political parties involved in both arenas?
Yeah, there is a slight, and I'm thinking back to a third data set that's not in this particular article, but as of a couple years ago when I wrote a slightly different article, having concordance, right? So having the party in Congress also be the party of the president, Republican and Republican, or Democrat and Democrat, is better than if there's a Democrat in the White House and a Republican-controlled Congress, or vice versa. You'd rather have them aligned, but at the same time, Bill, again, I've got a little bit of a math background, and I say to myself, we're talking about 20 or 25 four-year periods over the last 100 years, 25 data points over the last 100 years. Is that enough data to confidently sit back and say, yeah, we know exactly how this is going to work in the future? It's probably not. So again, if something happens this November and we have presidential candidate Harris is elected, but Republicans control Congress or vice versa, that's not going to affect my views on investing or my portfolio at all.
So we shouldn't go to cash before November 5th, right?
We shouldn't go to cash, Bill, but we should go to the voting poll. So whatever you think, whatever your views are, cast that vote at the voting polls. We all can do that, period. No matter how it affects our portfolio, make sure you cast your vote. But yeah, it's a political year, so honestly, everyone's thinking about it. It's all over the news, everything you listen to, our friends, our family. So we thought it was worth kind of chatting about a little bit and kind of level setting some things there. So we enjoyed that article a lot. Now, we're going to get into another article that's really a big thing that we talk about in our late starter community, and that's about having too conservative of a retirement. And we'll dive into that right after this break.
This show is sponsored by Boomer Benefits, one of the nation's leading family-owned Medicare brokers. Jackie, I am so confused about the alphabet soup in Medicare.
Oh my gosh, Bill, I am not the only one. And I'm a financial professional and I learned all about this stuff, but it is still confusing. But the truth of the matter is, most of us are close enough to care about Medicare where we have to figure this stuff out, no matter how confusing it is. So Boomer Benefits is here to educate you and to guide you every step of the way when you're ready to make that big decision.
So with Boomer Benefits by my side, I'll receive personalized Medicare guidance tailored to my health and my financial needs, all at no extra cost to me.
Yeah, Bill. And they can help evaluate which Medicare options are best for you based on your unique situation. And if you're already on Medicare, they can review your current plan and make sure that it's the right fit.
So let's visit boomerbenefits.com today and let them help us make informed decisions about our Medicare coverage. Gosh, Jackie, this is a godsend. I'm definitely going to do this.
That's right. They are the best.
All right, Jackie, we're back. And this article, The Crushing Cost of Conservative Retirement Planning, was fascinating to me because I tend to be a little bit more on the conservative side. You tend to be a little bit more on the aggressive side. You're retired. I'm not. So, Jesse, there's similarities between rocket science and retirement planning. And you use the model of a 50-year-old with $1 million and a spend of $100K. And you take us here through 3 different scenarios. And you ask the question, could the cost of conservatism result in decades of unnecessary work? That's decades. Can you take us through that article, please?
Yeah, absolutely, Bill. Starting with the first point or the first question you asked, which was, what are these similarities that I'm referring to between my old engineering career and retirement planning? And the idea there simply is, it makes sense. We have to essentially make certain assumptions when it comes to these plans. And to some extent, we want to be conservative in some ways or apply some factors of safety, as an engineer would say. But in engineering, when you apply different factors of safety, when I'm worried about what's going to happen to this rocket in launch, and I'm worried what's going to happen to the material properties, and what if this and what if that, those factors of safety, they all multiply with one another. And that leads to an ultimate or a final total factor of safety, if you will. So if I have a 50% factor over here and a 100% factor over here and another 100% over there, they don't add, they multiply. They compound, if you will. And your final factor of safety tends to be quite large when you stack up everything on top of each other that way. Well, in retirement planning, we could do the same thing. I don't think we should, and I'll explain why. And the idea here is, well, what kind of investment returns do you want to assume during your retirement? What kind of inflation do you want to assume? What will tax rates be? How will Social Security be there for you? If you're not careful, you're going to make potentially conservative assumptions in all these different factors, and you're going to end up with a view of your future retirement reality that odds are is far, far, far too conservatively skewed because you've stacked up all these conservative factors against you. So now segueing, Bill, into that example that you alluded to, which, right, I looked at what I just thought was a very typical 50-year-old pre-retiree, which, like you said, I think was $1 million in their portfolio and certain retirement goals. And I said, let me look at Social Security, investment returns, their future expenses, inflation, and tax rates. Let me look at those 5 variables, and let me dial them all the way conservative, then let me dial them back into probably a too aggressive stance, and then I'll dial them somewhere in between. And at each one of those dials, conservative to aggressive along that spectrum, I said, when can this person safely retire? And applying a lot of conservatism, although I will say, it's the kind of conservatism that I've seen and you guys have probably seen on Reddit, in our Facebook groups. Like, you see people will make these assumptions in their retirement plans. So it's not like I'm being ridiculously conservative here. This hypothetical retiree that I looked at, age 50, if they're being really conservative, they can safely retire at age 76. We'll keep that number in mind, age 76. But then if I try to just go down the middle to what I believe is a perfectly rational set of assumptions, they can safely retire about age 59. So 76 if they're being conservative, 59 if they're being what I believe to be realistic. That's what, a 17-year difference? I mean, that's huge, and it can't be overstated or understated. I can't think through the logic right now, the double negative. All I'm saying is conservatism, it can cost you many, many years of your life if you're not careful with it.
Yeah, and I think that fear of our money running out is so powerful, and we can't deny the emotional side. And I think that's what causes it. And like Bill said, I think me and Bill are kind of like on opposite ends. Bill is definitely more conservative. I'm probably more aggressive, and maybe that's how I was able to retire as early as I did. I never thought about looking at it that way because I retired at 49. Well, I pretty much have an all stock portfolio. I even have a single stock portfolio, but there were some extra conservative things that I did though. I didn't count Social Security. So I guess that would be the thing that balanced it a little bit. But I think that probably did have a lot to do with my ability to retire many, many years sooner than I thought I could, or the same person with the same set of assumptions that I have as far as lifestyle and things like that. So, Bill, do you think you're too conservative?
You know, I wonder that because I'm about 75-25 stocks to fixed income. I do have a 5 to 10% cash allocation, but I live in a job that's insecure. I'm only as good as my last mistake. And a job loss at this point could lead to retirement. So I don't think that I'm necessarily too conservative. I think I found my sweet middle, and I have extended my runway to retirement because I work less now. It's more of a life, work, finance balance. And then I also have the problem with retirement where what am I going to do afterwards? I might go the path of Jackie. She certainly had passions that eased her out of retirement, and she's, a financial educator extraordinaire. I may need to do my CFP to join you guys on that side of the arena because life is long, right? My life expectancy is to 80s, and how am I going to spend my retirement life? So I've got to still figure that out, and a job gives me structure. So I don't really complain, although I do a little bit. And I watch all my colleagues in the space retire in their 50s, and there's a little FOMO and jealousy and envy there, which are motivating, but not motivating enough to be more aggressive. And I think our late starters may get overly aggressive, say if they start at 50. I mean, you started at 39, which is a big difference, and you navigated the longest bull market in history where I kind of missed out on that. The assumptions, you mentioned the 5 assumptions. Can you tell us what those assumptions were for each of those 3 conservative, middle of the road, and hyper-realism approaches so people understand what your assumptions were in leading to those multiples of years working?
Yeah, totally. So let me start with the most conservative set of assumptions that I looked at. For that, I assumed that Social Security would not be there in any way, shape, or form for a retiree. I'd assume that their 60-40 portfolio returned a nominal 6.5%. So again, that's not 6.5% after inflation. That's just a nominal 6.5%. And then I assumed that their inflation, instead of the historical 3% per year, was going to be 5% per year. Again, just adding conservatism onto what we know historical standards to be. For their expenses, I said that this person's, now most of the time it goes down in retirement, but this person wanted to be safe, and they assumed that their expenses would actually go up in retirement. So they added a 25% buffer onto their annual spending. And then they assumed that their federal tax rates would increase, and they assumed a 20% effective tax rate in retirement. Again, this is a bit of the classic situation. Everybody's circumstances are so unique and different. This is just one set of my hypothetical person's assumptions. So now, does it make sense, Bill? Do you want me to go to the other end of the spectrum, to the most aggressive, or should I just go talk about that down the middle person who could retire at 59?
Let's start with the most aggressive and come back to the middle so people understand, because I'm a middle guy. Jackie's probably a most aggressive gal. So we'll get to the middle, but let's talk about Jackie's story since she started talking about my story.
Well, let's hear what Jesse has to say about that. And I think I can resonate with most of it. Go ahead, Jesse.
So now this next set, it is the most aggressive that I wrote about because there's zero conservatism baked in. And even I bake in a little bit of conservatism into my plans. So when I say zero conservatism, I don't assume that things are going to be better in the future than they were in the past. I just assume they're going to be exactly the same. So it's not like I'm out here assuming 20% stock returns forever. Instead, I'm assuming that Social Security will be there It'll be based purely on this person's income history and will likely pay them about $2,500 per month as measured in today's dollars. I assume their investment returns on a 60-40 portfolio would be 9%, because that's about the historical average of a 60-40 portfolio. I assumed inflation would be about 3% per year. Again, matches historical averages. I assumed that their expenses would drop by about 10% per year in retirement, or would be 10% lower in retirement than it has been during their working years, because that's about what studies show. Retirees tend to spend a little bit less. And then I assumed, even though they're a late starter, they're still smart when it comes to tax planning. I assumed that their effective tax rate throughout their retirement would be about 7.5%. So, right, that's balancing Roth distributions, maybe some smart Roth conversions, planning out their capital gains, harvesting at the right times so as not to incur too many taxes. So that was what I call the hyper-realistic zero conservatism case. And then last, and for what it's worth, maybe I should say, that hyper-realistic person, if they started at age 50 based on my scenario that I outlined, they could actually retire at about age 55. Wow. Then let's go to the person who has a little bit of conservatism, but not too much. And in my opinion, probably about the right amount baked into their retirement plan. I assume that this person's Social Security would be there. Now, at worst, I think you should assume that at least 80% of what's promised to you in Social Security will be delivered to you. We can get into that detail. For their investment returns, I assumed their 60-40 portfolio would return 8% per year. I assumed inflation would be 3.5% per year. I assumed their spending would be exactly the same in retirement as it was during their working years. And then I used an effective tax rate of 10% on the federal level for their tax assumption. And again, this was the hypothetical pre-retiree who would retire at about age 59.
That's the model that our audience wants to hear. That's the model I probably should have heard when I was 50.
To each their own, Bill. And it's funny hearing, Jackie, you and Bill talk about your differences in assumptions that you want to make. I don't think there's anything wrong with saying, you know what, I just rather be a little bit more conservative. I don't want to run the risk of retiring, quote unquote, too soon and then feeling stressed or going back to work. I totally get that. I just want to avoid the hyper conservative end of the spectrum where people want to layer 50 or 100% essentially factors of safety onto each and every variable in their retirement plan. And next thing, they basically look at the world and say, how will I ever retire? It's unrealistic. I never can. And then they're going to die with $5 million, right? Because that's ultimately what ends up happening in a lot of these cases. You're too conservative the entire time. You pull the trigger too late, and you never spend down your portfolio. And now the question becomes, well, what are your children and grandchildren going to do with all this money that you've amassed? When meanwhile, you probably worked 10 or 15 years longer than you could have or should have.
Yeah, I mean, it seems like these three models can apply to sort of generational approaches to investing. There's one model that you might approach at 20 through 40, and then you may shift to the middle model sometime between 40 and 50 if you want to retire early, and then you shift to the conservative model as you're entering retirement. Because one of the biggest mistakes, and we'll talk about the 24 biggest mistakes that DIY investors can make with Cody Garrett in the future podcast, and number 9 on his list was investing too conservatively early and then too aggressive late and flipping the switch.
Yeah, I think where we are makes a big difference because honestly, when I was approaching retirement, I felt like those 5 factors that you mentioned, Jesse, I feel like all of our audience should look at those 5 factors and see where they fall on those 5 factors. And I think as I was approaching, one factor that I was super conservative on was that I did not count Social Security at all. So now that I'm retired, I know I can count that. Now, I didn't work 10 years longer than I should have, but I stayed around and still worked for 2 more years because I needed a little bit more of a cushion on my investment portfolio, but also I wasn't counting the Social Security. So yeah, those factors are really important to look at, and it might sort of change some minds on when people think they could retire. I don't know, Bill, you think you might be changing your mind? Because I know you've been hard and fast on, you said 62 is the earliest you can retire. And now looking at some of these conservative things that Jesse mentioned, any food for thought that stuck with you?
Well, we didn't start at 0 at 50. We certainly had assets, and I've subscribed to the sort of 12 to 13-year plan. And 63 is kind of the number. I'm going to use July 4th, Independence Day, probably, my retirement day, just like Jesse does with the best interest. I got to have a reason. And my wife's probably going to work longer, and that plays into it too. She has more longevity in her job than I do. Mine's more like a professional sport. I work nights, weekends, holidays, and I could hit it more and maybe retire early. But at my age, recovery from these shifts factors into how I plan my work life. And I value my time off and my flexibility for time off more than I value sort of killing it in the empty nest, which would have shortened my runway. There's a lot of factors that apply here. And I'm going to do a retirement assessment at 60. So another year away, where I have somebody look at where are we at, and is 63 a reasonable time for me to retire while my wife continues working. So I'm a DIYer till then, and then we'll do a readiness plan, or maybe I'll do it sooner. But I think that's my approach. And if I'm told at that point that I'm working longer or spending less, then we'll adjust at that point.
Can I ask a quick question, actually, Jackie, about your Social Security assumption? It might be enlightening for the listeners. I'm just curious if your thought was, you know what, I do want to have something conservative in here, and I'm just going to assume this zero here, even though maybe in the back of my mind I know it's not going to be a zero. Or did it have anything to do with the fact of the Social Security trust running out of money in 2034, something like that? Or potentially was it just that you are retiring early and you don't have as many Social Security credits built up as someone who maybe has a full 35-year work history, and that's the reason why you want to assume it won't be there for you?
I think for me at the time, it was a combination of all of those and just really not being well versed on how Social Security worked, but also like being in certain groups where people would say, I'm not counting Social Security at all, and the trust fund is going bankrupt, so you won't get any Social Security. And I was overly pessimistic about the whole system. But since I retired and I really learned how it works, I was able to project my earnings and go to ssa.gov. So I realized after the fact that there was a lot of political undertones when people would say it's going to be gone and things like that. And I just said, you know what? I can't make sense of any of this. I'm just going to throw it out and not include it. So I just kind of shut down at that point. And that's probably how a lot of people do. Honestly, the most conservative I probably should have done was, like you said, about only counting on about 80% of the projected benefits and assuming taking it at 62. That's probably the most conservative I would do. Now, of course, if I wait later and all of that, that's going to make it better. But if I want to do the most pessimistic and the most conservative. So that was my thinking around Social Security. And I don't know if, Bill, you've done a lot more research than I had done before I retired on Social Security. So yours will be there. Are you feeling like that's a part of your plan?
Oh, absolutely. And that's a superpower of the late starter that you can't forget. I mean, I'll have the credits. Our plan is sort of, we'll see $3,500 to $4,000 each per month. So it'll be significant. It'll be another $1 million to $2 million portfolio that is inflation adjusted based on Social Security. So yeah, it's absolutely part of the plan. I think late starters absolutely have to include it, and probably in the middle of the road fashion with 80%. So don't forget about it. And then you have to decide, in a married couple, both who have worked, when you take it. And Mike Piper has a great calculator that helps you figure out. Generally, the higher wage earner should wait till 70, and the lower wage earner can adjust in there somewhere. And I think for me and my wife, it would be her around 65. So that's the sweet spot for us. And everybody else will have a different sweet spot based on their circumstances. But Mike Piper's calculator, and it's opensocialsecurity.com, is where you should really plug in your numbers to find out what your Social Security plan should be. We're going to take another break right now, and we have a really fun article to talk about after the break. Jackie, let's pause for a minute. And before we continue, let's share some words about one of this week's sponsors, Delete Me.
Yeah, the latest report from the Federal Trade Commission showed that in 2023, $10 billion was lost to consumer fraud, and $2.7 billion of that was lost to imposter scams.
Yeah, they've tried to scam me. They've scammed my mother. This is a real problem. So what do you do about it? Well, first off, just learning more about the tactics these scammers use can help us know what to look out for. But in a big way, I try to keep our family protected is to make sure that all of our personal information is removed from as many data broker websites as possible so that we're less enticing of a target.
Yeah, you'd be shocked at how many sites out there are sharing your address, phone number, birthday, email, and a lot more. But fortunately, you can get these data brokers to remove your information. But unfortunately, the process takes hours and hours to do it by yourself.
I know, because I tried to contact them, and only after spending 10 hours did I give up and start using Delete Me, our sponsor today. So take control of your data and keep your private life private by signing up for Delete Me. Now at a special discount for our listeners, just go to joindeleteme.com/catching up. That's joindeleteme.com/catching up. You'll find the link in our show notes. All right. We're going to talk about a single stock. Now, full disclosure, Jackie has individual stock portfolio, and we're not necessarily recommending individual stocks to our audience. It's too concentrated of a risk. I only have one. I have a small amount of Berkshire Hathaway, so maybe I'll go to Omaha one year, and it's functionally a value add mutual fund, and it's a little fun to watch how it does compared to everything else. But I think Jackie is a NVIDIA investor, and we're going to talk about NVIDIA's day in the sunflower. Now, this is a great article I encourage everybody to read because it talks about, can this go on forever? And if it did, what would happen? All right, Jesse, take us away on your garden, sunflower, and NVIDIA metaphor.
Thank you. I love the introduction. And by the way, Berkshire Hathaway is the only single stock I own. Very much, I say it's like the reason why someone owns a Yankees baseball cap. It's because you're a fan and you want to have some little token of your fandom. And for me, that's shares of Berkshire Hathaway B-class shares. So anyway, Bill, I like that. Yes, NVIDIA's day in the sun/sunflower, a little bit punny. So the whole idea of the garden metaphor is, imagine that you are a small-time gardener and you build a couple beds and you absolutely love it. It's a joy for you that summer. So you come back the next spring invigorated and you say, I'm going to do more of it. And those first few years of gardening, it's pretty easy for you to grow the size of your garden. You can double it in size for quite a few summers in a row. But then at some point, doubling in size becomes it's no longer feasible, right? You don't have the space to double the size of your garden. You don't have the resources in terms of water or fertilizer or time or anything like that. And the lesson is that growth can't be exponential forever, and that eventually size itself becomes the enemy of future growth. It's true for Mother Nature, and it turns out it's also true for economies or economics or financial topics. And now going to the sunflower metaphor, I had this image of my head of, imagine that we're looking in our garden and we have these nice fully grown sunflowers, which if you don't know, they sprout, they can be 8-10 feet tall. And then next to the sunflowers, we have some corn. And so we have these fully grown sunflowers kind of towering above us. And next to it, the corn blooms a little bit later, we'll say. So the corn is maybe only half grown and there aren't any ears of corn yet on the corn stalks themselves. And now if I were to, quote unquote, invest in these crops in some way, if I were to say, well, which one's going to do better? Which one has more growth potential in front of it? Because again, as investors, we shouldn't be thinking about the past per se. We should be thinking about the future. Which plant has better prospects? Well, if I look at past growth, I'd say it's a sunflower. Look how much it's grown. It's fully grown. It's got this beautiful head of sunflower seeds on it. And the corn, meanwhile, how can you even call it corn? There aren't any ears of corn on the plants yet. Why would you invest in that? Well, of course, we know that once a sunflower has reached maturity and it's a head full of sunflower seeds, within 2 weeks, it's going to be dead. And the corn, meanwhile, still has weeks of growth in front of it. It's got these beautiful vegetables and tasty vegetables that will come from it. And the same idea there applies in the stock market, which is that if we look backward, right now, today, it's August 27th, 2024. If we look backward and we say, what have the best performing stocks been over the last 5 or 10 years? The answer is going to be, it's the largest stocks. It's the tallest stocks, if you will. It's the sunflowers. Whatever has grown the most over the last 10 years, that's what's now the biggest stocks and quote unquote would have been the best investments. But the problem is, going back 5 or 10 years ago, you didn't know which stocks were going to be the ones that grew the most 5 years in the future. If you did, and you could predict the future that way, you ought to be a billionaire or a trillionaire by now. So instead, if we had gone 5 years ago and we had said, all right, let's just measure where every stock is now. Here it's 2019, right? It's 5 years ago. Let's just measure where all the stocks are right now. And then here we are in 2024. Let's use those same measurements and say, which stocks actually did the best over the past 5 years? The answer is actually, it was the smaller stocks 5 years ago that had the most runway to grow into what they are now. In other words, investing in the half-grown corn 5 years ago turned out to be the smarter investment choice. And all I'm trying to make there in that point is looking at the tallest stocks today, if you will, the ones that have grown the most recently, isn't necessarily going to be a guaranteed investment strategy that works for you. In fact, data shows that once a stock has reached, say, the top 10 in the stock market, like NVIDIA recently did, Apple, Microsoft also in the top 10, history shows that those stocks actually tend to grow slower in the future. So some people would call that the small cap premium. We don't have to get into that per se. But a couple of the stats that I think you alluded to in the introduction, I think it was you, Bill, would be, I wanted to say, what if NVIDIA really does continue this rate of growth that it's been on recently? So in the last 5 years, from July 2019 to July of 2024, NVIDIA grew by about 30 times. They grew from a $100 billion market cap to a $3 trillion market cap. And what if it does that again over the next 5 years? What if it grows from a $3 trillion market cap to a $90 trillion market cap? Okay, well, $90 trillion, that size company, would be as large as every other publicly traded company in the world, all combined. Right? It would be 3 times the annual gross domestic product of the US, 3 times our annual GDP. And for kicks and giggles, it'd be roughly $90 trillion more than my personal net worth. So I just thought those 3 factors were reasons why NVIDIA, there's no way that it can continue to grow at the rate that it's growing.
Wow, and that's an engineer right there. He's looking at the numbers, but you're totally right. And we know probably the vast majority of people don't need to be buying single stocks. We talk on the show a lot about index funds, the J.L. Collins simple path to wealth type thing, but most people have 1 or 2 individual stocks they like to own, but that's a good way to look at it. And who better to kind of explain that than an engineer that has all this financial expertise. So that was pretty cool.
But in defense of you, though, Jackie, what I will say is, and I don't know the ins and outs of your portfolio, Jackie, but this is where the whole conversation of position sizing comes into play. Because if someone were to sit here and say, well, listen, I mean, here's a real truth that Bill, you and I need to face, as well as I'm sure many of our listeners. Great, you own the S&P 500 index fund, and that's a pretty big part of your retirement portfolio, let's say. Well, 5 or 6% of the S&P 500 right now is NVIDIA, something like that. So even if you say I have a diversified stock portfolio, it's large cap, mid cap, small cap, and I own some bonds in there too, you still might have a 2 or 3 or 4% position in NVIDIA. So if Jackie's over here sitting, and like I said, I don't know what your portfolio is like, Jackie, but let's say you own 20 individual stocks and 6% of your portfolio is NVIDIA. That's not that much different than where the rest of us are sitting in our index funds. It just looks a little bit different. So like I said, position sizing really matters too.
And you have a quote from Uncle Warren Buffett that the giant disadvantage we face is size. In the early years, we needed only good ideas, but now we need good, big ideas. What do you think about that?
Yeah, it's so cool. I'm reading Roger Lowenstein's biography of Warren Buffett right now, which is a great read if you're a Buffett fan. And it's so cool looking back on Berkshire Hathaway history, or even before that, when essentially Buffett ran a hedge fund for like 30 or 40, up to maybe 80 investors before he kind of started the whole Berkshire Hathaway thing. And at the time, he was dealing with single-digit millions of dollars. And if he could find a $500,000 investment that would triple in size over 5 years, he was going to take it. And that really moved the needle when he was working with those small sums of money. Well, now Berkshire Hathaway is what? Is it $1 trillion company yet? I think it is. But either way, for Warren Buffett to spend time and resources and paperwork to make a $500,000 investment, it just doesn't move the needle. Instead, he's looking for multiple billion-dollar investments. And the problem is that once you get to that size of an investment, a lot of other people know about it. You know what I mean? It's like saying, I want to scout for a really good baseball player. Well, if your plan is to pull a baseball player off the Yankees, everyone else realizes that that person's a good baseball player too. So instead, you have to look in the places where no one else is looking and hope you find a diamond in the rough. So going back to the quote, right, the whole idea is that once something gets really, really big, it's difficult for that thing to continue to grow in size at the same pace.
And then Uncle Reuben, I found this interesting because the presumption is the stock market has averaged 10% year over year for the last 100 years. So if that continued while NVIDIA averaged 32%, which it has had since its IPO in 1999, take us through what it would be in 10, 15, and 25 years.
Yeah. So Reuben Miller is another professional investor. I believe he runs a small investment management or financial planning firm. And I really like his writing. And that's how I discovered Reuben. He writes a blog and he's very insightful. And yeah, so his math here, Bill, is essentially that, well, if the rest of the stock market continues growing at 10% per year, and meanwhile, NVIDIA continues, I think he uses a 32% rate of return for NVIDIA because that's how it's grown since its IPO in the late 90s. So these two lines that are, again, these aren't straight lines, right? These are compounding hockey stick type lines, one growing at a 10% rate, the other growing at a 32% rate. If you do that forever, and this gets into some, again, the math majors out there will know this, but maybe if you're not a math major, you won't know this. If you truly compound two things forever, the thing with a higher compounding rate will always, always, always catch up to the thing with a lower compounding rate. It's just a matter of time. Always, always, always. It's just a mathematical rule. So, okay, NVIDIA is compounding at 32% per year. If it does that forever, it will eventually catch up to the entirety of the stock market if that stock market is only compounding at 10% per year. So Warren's point here is that something around, if they continue growing at this rate, in 15 to 20 years, basically NVIDIA will be bigger than the entire stock market, including NVIDIA. And it's kind of like a mathematical impossibility. And Reuben's point, which kind of backs up my sunflower story, I guess, but Reuben's is more succinct, is that eventually nothing can be more than 100% of something that it's part of, right? NVIDIA is a slice of the pie. The stock market is the whole pie. And eventually this math suggests the slice that is NVIDIA will be bigger than the pie itself. And we've all eaten enough pie to know that that doesn't make sense.
Yeah, and I can say that I definitely don't like any one stock, including NVIDIA, taking up too much of my portfolio. Typically 10, maybe 20% if it's Berkshire Hathaway, right? But for the most part, if I'm to your point about seeing this peak or stocks that just continue to go up and has all this compounding, we know that it's going to level out at some point because it can't be bigger than what it's a part of. Mm-hmm. So at that point, I'm thinking, how much longer do I want to keep it? How much do I want to keep? And at what time? I generally like to just shave a little off at a time. I'm not selling it all at once or whatever. So you've definitely given me some great food for thought as someone that does have an individual stock portfolio, that does have NVIDIA and many other stocks as well. But again, J.L. Collins talks about like the S&P 500 total stock market index fund as well, that is being self-cleansing. So it's constantly looking at things like that. So I think the pros definitely keep that in mind, and they probably know all of this. So I'm thinking when it comes to risk, though, you wrote a little bit about this on your blog. How should we be looking at this? So there was an article talking about the need, the ability, and the willingness to take risk. So we talked about NVIDIA, we know about index funds and everything and how conservative we should be. So can you talk a little bit about that need, ability, and willingness to take on this risk?
Mm-hmm. Yeah, so need, ability, and willingness are just these three potential filters that an investor can use to understand their own risk tolerance, or when having a conversation with someone who's interested in investing, you can try to understand their risk tolerance. It's not the end-all be-all. For example, I love looking at historical data and showing people some of the things that have happened in the stock market in the past and just saying, if this happened to you, how comfortable would you be with this? That's one of the ways that I try to understand someone's risk tolerance. Start in 1998 and start investing in the stock market, and then wait until 2010 and look at how your investments did over that 12-year period. How does that make you feel? So anyway, that's another approach that I have, but I digress. Going back to need, ability, and willingness, these three phrases, then someone's need to take on investing risk relates to the amount of growth that they need to reach their financial goals, right? So this is perfect for late starters, because if you are really a late starter and you're kind of starting from, say, square one, and you only have a shorter runway ahead of you to your potential retirement, you might have the objective need to take on quite a bit of investing risk in order to secure enough investment return to meet your defined financial goals. So that's what someone's need for risk looks like. Their ability to take on risk, though, can be a little bit different. It's similar, but I think of it as kind of the opposite side of the coin, because an investor's ability to take on risk is based on their capacity to withstand or recover from losses. And this takes two different forms. One form could just be a really large asset base where someone says, you know what, yep, I'm going to make a $50,000 investment here, and if it goes to zero, I'm okay, because I've got a lot more money where that came from. But the other form of ability maybe skews towards younger listeners out there, or at least people who have told themselves that they have a really long runway ahead of themselves, where through thick and thin, they plan on continuing to invest over time, right? They're going to dollar cost average for many, many, many years. And so, you know what? If the market drops here in 2024, doesn't matter to them. In fact, they're going to invest straight through it. They're going to continue contributing straight through it. So they have the ability to take those potential losses, whether they're temporary losses or what's the opposite of temporary, forever, and they're going to recover and they're going to be fine. They're going to keep on investing through it. And then last, willingness. So you might notice in those definitions, need and ability are reasonably objective, right? They should be based on pretty hard numbers. Willingness, though, is not objective. It's subjective. It's very much based on the individual that we're working with and the person that we're speaking with and what's going on in their mind. How will you react to the higher volatility that comes with high-risk investments? Are you willing to stomach losses? And this factor, the willingness factor, definitely can complicate conversations, because if someone has a really large need for investment risk, but their willingness can't stomach that risk at all, how do we square that circle? Or the opposite, if someone really, really wants to take on huge risks in their portfolio, but they really don't need to, and you have someone who, say, is perfectly safe for retirement, right? All the numbers add up, and yet they come to you and they say, NVIDIA is going to double again. I want to go all in on NVIDIA. And they are risking, that's 100% of their investments in NVIDIA right there, not you, Jackie, right? Well, that person, all of a sudden, they're putting their quote unquote safe retirement at risk because they're so willing, they so badly want to take on risk. So anyway, it's interesting when someone's willingness doesn't align with their need or ability. But I'll pause there and let you guys chime in.
Well, this brings up a quote for me from Bill Bernstein, where he says, when you won the game, stop playing. And that rings so true. That's a very famous quote of his. And when your willingness to take risk is too high going into retirement, that's where that statement from Cody Garrett comes in. You're too conservative early on, and then you're too risky later on. You've got to build, say, a bond tent to avoid sequence of returns risk, which is a very real entity that you've got to navigate through as a retiree. So assessing risk is a very important part of making a retirement plan. And you see from a lot of big box custodians a risk assessment survey, which are relatively useless. And you've got to talk to the advisor and answer these three questions in order to make a valid plan. What are your goals? Probably should be in that list as well.
Yeah, I agree with you on that, Bill. So I think a lot of this starts to come to mind when you are talking about our late starters. And as we wrap up the show, Jesse, we always like to talk specifically about tips and things like that for late starters. But you specifically wrote about older beginners. So let's say someone's starting at 55 or 60 or a little bit later. What are some of your best tips for people that are not just starting late, but they are older in life?
Yeah, one of my favorites, Jackie, and it actually comes from a study that Fritz Gilbert, who's from the Retirement Manifesto, and I believe a second gentleman put this out together. And they polled a whole bunch of Fritz's audience, and one of their findings that really stuck with me is that the number one concern for most pre-retirees, so like people who haven't retired yet, their number one retirement-related concern is financial. right? Do I have enough money? Will it last? All these kind of things that we've been talking about today, that you guys talk about every week, and understandably so, right? I think we all understand why that's such a big concern for pre-retirees. But the cool part of their findings was that for post-retirees, for people who'd been retired, I think it was either for like 3 years or 5 years, or maybe they were somewhere within their first 5 years of retirement. That's who the cohort was. Finances weren't even close to being one of their top priorities. Instead, their top priorities had to do with health, had to do with relationships, had to do with finding purpose, had to do with hobbies and what they were doing to occupy their day. Those are the things that all the people who are actually retired start worrying about. And so one of my biggest tips that I give to late starters, people listening to us right now, or just simply people who are on that final approach into retirement, is this understanding of, hey, once you get to the point where you're pretty comfortable with your finances, you really need to pivot and start thinking about all the other stuff, because that's really what's going to be most important throughout your retirement. And it's what's most important in life, right? I don't think any of us want to be people who say money is the most important thing to me above relationships and my health and all that stuff. But for anyone who's read or seen the movies The Hobbit, which I finally caught up with my Hobbit watching. I hadn't watched the movies. But you'll know that Thorin, the dwarf king, once he becomes king under the mountain and reclaims his home, which is full of gold, he becomes ridiculously obsessed with these gold and puts it above all the relationships and almost torpedoes the entire storyline because of his obsession with money. So we don't want to do that. So now, Jackie, I'm not sure I would share those dwarf tips with the average person, but if you're a Hobbit fan, you'll appreciate that. But yeah, there are certainly some other things. I'm happy to go into detail, but I'll pause there.
Well, we're going to link the article in the show notes, and we encourage our listeners to go through your articles and embrace your blog, because it's a weekly blog. It's succinct. It boils down in your engine, your mind, complex topics into digestible bites. And I signed up for your newsletter, so I would encourage all of our listeners to do so. As we wrap up the show, do you have any parting tips for late starters, and where can people find you?
Yeah, well, thank you guys so much again for the opportunity. This was awesome, and thank you for subscribing, Bill. Where can people find me? That's a straightforward one, bestinterest.blog. And if you go to that blog, there's a little newsletter sign up on the homepage where I send out my weekly articles. I send out my new podcasts. The podcast is available everywhere. So if you're really only a podcast listener and you don't really care about the written stuff, that's fine. Wherever you're listening to this fine podcast, you can also find the Best Interest podcast there. Tips for late starters, I mean, it's cliche, but what's the Chinese proverb? The best time to plant a tree was 20 years ago. The next best time is right now. That's really true. And I think for the average person listening to this, don't only think about your timeline between now and retirement, which might be 3 or 5 or 10 or 15 years, but think about all that time after retirement, which is likely multiple decades. I mean, that really is the timeline that you should be thinking about. And it's probably for the average listener right now, 25 or 30 or 40, maybe even more, 50 years for some of you. And that's a lot of time. And there's plenty of time to catch up and to live long and prosper. So anyway, I wish everybody good luck and Godspeed.
Well, that was a Spock quote, so I guess we should Spock retirement. That's another article for you. How to Spock retirement.
Yeah, I appreciate that you talked about all those years post 50 or 60. Like, early retirement is one thing, but that's only a small piece of retirement as a whole. Most of us are going to live until our 80s on average. And so we got to think about that part too. So some of the money that we have in our investment portfolio, we're not touching it for another 20, 30 years, even after you retire. And that was sort of a part that I wasn't really looking at and realizing, but I appreciate that point. And it's just been a whole gold mine, honestly, having you on the podcast, because we knew that you had so much knowledge and so many cool things that you had written about that would just be really fun to talk about. So thank you for that, Jesse. Bill, you got any last words?
No, this has been awesome. You never know what you're getting into with the podcast. And every time I'm impressed with our guests and what they bring to the table, especially with Jesse. Everybody should take the advice of a rocket scientist, even though you don't consider yourself one. So Jesse, thank you for being here today. We'll certainly come back and talk to you again when there's other information that we need to share with our audience.
Awesome. Thank you guys. Really appreciate it.
So, Bill, as you know, we cannot do this show without our amazing staff and the people that help us put this on. So our social media is Diana Falk, our editor Fritz Bassard, and show notes are done by Sarah von Sternberg. We love them and they keep us going.
Yeah, I mean, this show wouldn't have the quality it has without our folks, our peeps. And we'd also like to give you a few calls to action for the show. We love our community and we hope you love us back. If you want to support the show and what we're doing, you can do that at Buy Me a Coffee, which is a platform that allows you to virtually say thank you if you get value from our content. The link is in the show notes, or you can head over to our website at catchinguptofy.com and click on the Support the Podcast tab at the top right. We hope you've enjoyed this episode of Catching Up to Fi. We would appreciate it if you could leave us a 5-star review so that our message can reach others.
While we are financial educators, and I'm a financial professional that loves to teach, our content is for general education and information purposes only. We are not providing financial, legal, or tax advice. Always do your own research or consult a professional before making important decisions.
We'll see you next time on Catching Up to Fi.